Good day overall for the bulls. You can see the bears, they tried to get the sell-off from bar 71 down to the end of the close, and they couldn't do it. Big bear bar 75, weak follow through 76, and then obviously 77 formed a bull doji, and the bulls managed to get a rally, managed to get a strong bull bar into the close. Let's talk about the daily chart. Daily chart, we have a bull bar closing on its high, but it's an inside bar. And it's an inside bar in a micro channel from over here. So a 5-bar bull micro channel, not including the current bar. That increases the odds that we're probably going to fall. We'll probably fall below the low of the prior bar. In other words, today's low tomorrow. And we'll probably end the micro channel. Tight bull channel on the daily chart, good for the bulls. Even if we get the sell-off, there's probably buyers below, but I suspect we probably will have to test the moving average soon. We're so close to 6,100 that we may have to rally up to 6,100 over the next couple of days before we get the sell-off to the moving average. Weekly chart. Weekly chart, we've had consecutive buy climaxes, and we're getting near the tight trading range from over here. And that increases the odds that we may end up pulling back soon. Coming into the day, yesterday we had a bear channel. So forming lower highs, lower lows. And we have a lot of trading range price action over here. And on bar 1, we gapped down. And we formed a bear bar closing on its low. Relatively big bar. Forcing bears to risk a lot and ride its support. So really not that great of a sell. You can argue it's a bear bar, but one of the issues with bar 1 is bar 1 does not look like bar 20 yesterday. Bar 1 has a big tail above and a small body. In other words, bar 1 price went more in the bullish direction above the open than it did below the open. Even though it closed on its low, it's still, the tail is a problem, and that increases the risk of buyers below, plus we're at the bottom of a trading range. 2, reversal up, good for the bulls. Increases the odds that the market may find buyers down here. Let me make this chart a little bit bigger. There we go. So increase the odds that there might be buyers below. 3 consecutive bull bars, good for the bulls. Probably going to get a second leg up. So probably buyers on a retest of 2 for a small second leg up. 3 and 4, good for the bulls. Testing the moving average, but overlap with bar 1, overlap with bar 4. Probably going to pull back, but if we do, I still think buyers below 5, scaling in lower. 6, bear bar, good for the bears. Let me just adjust something here. Bear bar, high one buy, but you can argue sellers above, but after that many bars up, I suspect we're going to go at least a little bit higher. And we'll probably get a second leg up. 7, doji, probably buyers below 7 for at least second leg up. And then 8, bull breakout, good for the bulls, probably going at least a little bit higher. 9, consecutive bull bars, good for the bulls. And then 10, another bull close. Strong enough bar, I suspect we're going to go higher, so still buy the close. And then 11, we have a doji. That doji bar, with it being a second leg up, increased the risk that we may pull back soon. But I suspect the first reversal down is going to be minor, and therefore you'll have traders buying below. Bears, they're not going to sell below 11, and because of that, you'll have a lot of bulls just buying at the market, betting that whatever reversal down we get is going to fail. 12 outside up, good for the bulls, so still buy the close. But an outside bar usually is a warning that we're going to evolve into a trading range soon, and therefore my concern is we'll probably test the high of 12 at some point soon. 13, weak bull bar, but still probably going higher. And then 14, second leg up after 12, good for the bulls. But again, as far as buying the close of 14, I would not. For me, I think the odds are we're probably going to have to pull back. 15, bear bar or bull bar, but a small bull bar, increases the odds of sellers not far above and a pullback testing the 12 high. 16, small bull bar, again, probably going to pull back. And then 17, bear bar, good for the bears, probably going at least a little bit lower. 18, consecutive bear bars. Consecutive bear bars after a series of bull bars from bar 7 to 16, probably going to be minor and therefore probably buyers below. And then 19, surprise, a second leg up after the rally up to 15, good for the bulls. What about buying the close of 19? That's really a little bit dangerous. Buying the close of 19 after a series of bull bars with consecutive buy climaxes, buy climax up to 5, buy climax up to 16, another buy climax up to 19, that increases the risk that the market may pull back soon. And then 20, bear bar, closing on its low. For the bears, I think it's an okay sell, betting on a couple of legs down and a test of the 18 low at a minimum. Bears have the argument of a parabolic wedge, and therefore 19 is probably the top of the third leg, so we may test down to the 18 low. 20, always in bulls, I'd get out below the bar. Too much risk that the market is probably too much risk that the bears are going to get a couple of legs down. 21, bad high one buy, probably sellers above. And then 22, outside down, good for the bears. What about buying the close of 22? Some traders will, but we may end up getting a deeper pullback than what traders want. And 22 might be enough of a surprise. We may go a little bit lower. 23, consecutive bear bars, good for the bears. What about selling the close? I would not. The risk is getting too big for the bears, and therefore it may be a second leg trap. Plus, it's a sell-off to around the midpoint of the day's range, low of 2 to the high of 19, and there might be more traders buying down there than selling. This is really more of a buy zone than the sell zone at this point. Bull bar 24, good for the bulls. However, we may end up going sideways. It's going to be hard for the bulls to undo the past 4 consecutive bear bars. At least, let me say it differently. It's going to be hard for 24. 24 is probably low probability of just going straight up on 25 all the way up here. And therefore, the bears that sold 23 and scaling in higher, 24, I suspect at a minimum, they're going to be able to avoid a loss, and they'll probably make money if they're willing to scale in. Low one short, 25, probably buyers below for a bounce. And then we have a doji, 26. And you can see we ended up going sideways for several bars. 29, bull bar, second entry buy. Bears, they've had 2 attempts back down, testing the 23 close. I suspect we're probably going to bounce, and at some point, I suspect we're going to rally fairly soon. What do I think the targets are? 19 close. I think the bulls that buy the 19 close and buy above a bar like 29, they're probably at a minimum going to get out. At a minimum, there's probably an 80% chance that they will get in between their 2 entries. So you buy the close of bar 19, you buy another contract. So you buy one contract 19, you buy another contract 29 above the bar. Break even is somewhere in here, and the odds are high we're probably going to get there. There's probably at least a 60% chance that we're going to get up to the 19 close later today. Follow through 30, good for the bulls, probably buyers below in a second leg up. 31, bear bar, outside down, but I suspect buyers below. And then we have a bull bar, 32, good for the bulls, probably going at least a little bit higher. 33, consecutive bull bars. Still probably buyers below, scaling in lower. But becoming difficult for bulls to buy. Buying right here is forcing you to buy in the middle of the overall range, and it's a possible 50% pullback for the bears, and there's tails above bars, and that increases the risk of sellers above. 34, bear bar, probably buyers below scaling and lower. And then we have a decent bear bar, 35. Good for the bears, but I suspect there's going to be more traders buying down here than selling. So really not a great place for the bears to be selling. Plus, on a 15-minute chart, this might be the early formation of a low one. In other words, a retest of the lows. And therefore, there might be more traders buying down here than selling. 36 bull bar closing on its high. Good for the bulls. Probably going to go at least a little bit higher. But because of the consecutive bear bars, 34, 35, in an overall trading range, they may still get the second leg down. And you can see what happened with 37. Bears who sold to close at 35, scaling in higher above 35, made money with the second leg down, 37. 38, 37, strong enough reversal, will probably go higher and test up to the close. But it's still forcing bulls to buy in the middle of a trading range. So really not ideal. And then 38, bull bar closing in the upper third of the range. Probably more sellers up here than buyers. But I suspect we'll probably go above the 19 high. For me to buy, the only thing I'm willing to do is sell until the bulls can demonstrate more signs of strength, such as a clear breakout with follow through. Then we high one buy 39, but probably sellers above. And you can see 40, we got a bear bar closing on its low. Good for the bears, probably going at least a little bit lower. 42 consecutive bear bars, 32. When I said 40, let me back up. I'm getting my numbers mixed up. 40 is this bar closing on its low, probably going a little bit lower. 41 consecutive bear bars, good for the bears, probably going at least a little bit lower. Bears want to double top with 19 closing, and they want to break below the neckline, 23, and a measured move down. But then 42, that's a weaker bear bar, getting in the bottom third of the trading range, 23 low to the 19 high, probably more buyers down here than sellers. And then we reversed up 43. But the reversal up, as strong as it is, I suspect it may lead to more sideways trading rather than a successful breakout of the range. And an inside bar, 44, good for the bulls. But now 2 legs up, probably sellers above 44 and above 43. 45. Good for the bulls, but I suspect sellers above, and therefore I'm not willing to buy up here. 46, another bull bar, but a lot of overlap, increases the risk of sellers above. And then 48, bear bar closing on its low. Good for the bears. A little bit difficult for selling below the 47 low, especially after 3 consecutive bull bars, but it's an okay sell. And then 48, doji, probably buyers not far below and at least a bounce. And then 49, reversal up, good for the bulls, probably going to go at least a little bit higher. Let me say it differently, strong enough reversal bar, good for the bulls. We may go a little bit higher, but I'd like to see follow through buying before I'm willing to buy up here. This is a possible late breakout and failed breakout of this bull channel. And then we have a doji, 50, bad follow through for the bulls. High one buy 51, but probably sellers above. And then a bear bar closing on its low, 52. Good for the bears, but bulls will see it as 2 legs down and a test of the breakout point, 48 high. And therefore, there might be more traders buying right here than selling. 53, bull bar, but a micro channel from the 52 high, not a good buy. And then 54, bear bar closing on its low. Good for the bears, but we keep alternating bull bars and bear bars. And that increases the risk that we end up going sideways here. Doji, 55, probably sellers above. And we started going sideways for a lot of bars. 58, 59, we finally got the bear breakout below the tight trading range. Good for the bears, but let's see what they can do. And then 60, they tried to get the downside breakout and they couldn't do it. 60, strong enough breakout bar, we may get a second leg down. There was some unfortunate bear who sold the low tick of 60, and now they're trapped and they're deciding what to do. A lot of those bears probably scaled in. And what are they going to do with 61? They're going to say, wow, that was a bad trade. Maybe it didn't do what I wanted it to do, and therefore maybe I should get out break even on the entire trade. So they sell during 60, they scale on higher, and now they're trying to get out break even during 61. Bull bar, 62, good for the bulls, probably going at least a little bit higher. And then 63, reversal down, good for the bears. We may try and fall below the 60 low, but right now, middle of a tight trading range, really better to wait for something more clear. Second entry buy, 64. Okay, swing buy, but still low probability. And then we ended up getting 3 consecutive bull bars, 65, 66. Good for the bulls. We may go a little bit higher. But look at the symmetry of the bars. A lot of overlap, 64, 65, 66. And that increases the risk of sellers above. And then look what happened with the next bar. 67, weak body, sign of the bulls losing momentum and therefore losing energy. Probably more sellers up here than buyers. And then 68, a bull bar, but even smaller body. That makes me think we're probably going to reverse down soon. And then 69, bear bar. Not a great sell after 4 or 5 consecutive bear bars, but I suspect probably not a lot of buyers above 69 or 68. Bull bar 70, but then we got the reversal down 71. And I thought 71 was a credible sell with a small, you could use a tight stop either above 71 or above 19, taking a chance that we get just a sell vacuum test of the 60 low or 63 low. So to me, that trade made a lot of sense. However, instead of getting that, we got bad follow through 72. And that was a warning that there was not a lot of energy behind the short. What you want to see, the gold standard of stop entries, this is kind of my gold standard. This is a 10 out of 10 on the stop entry scale. It's a relatively small bar, so it's not great. But when I say 10 out of 10, I'm talking about the follow through. You sell below 1 right here, this bar, you sell below it, and then you see what happened. Your entry bar. I actually remember this trade. And I remember what happened was I remember the bar trigger. And so I was not willing to sell below 1. And I remember bar 2 triggering the sell below 1 and going down. And I saw it going down, it went down kind of steady. And then it would pull back for a tick or two and then go down a little bit more. And I remember thinking to myself, gee, that's a strong enough sell off intra bar. I'm going to try and sell a pullback. And I would set a limit order 2 or 3 ticks above the current price. And I just couldn't get filled for a couple of minutes. And then finally, somewhere in here, I just said, the heck with this. This is going lower. Let me just sell the market. And that's what you want to see. So when we're looking at this, that's what we want to see right here. We want to see the market going down steady and only pulling back for a bar or two and then going even lower. And instead, we're not doing that. 72, 73, sign of weakness. Bulls will see it as 2 legs down and sideways. And then 74, doji, not a great buy above. So we'll probably get at least a small second leg down, but too late in the day to really do anything. And at this point, I think it's better if you did take the sell below 71, it's probably better just cut your trade for whatever profit you can get. 75, bear bar, good for the bears, but a bear breakout below the bear channel. The channel being these 3 bars, and we broke below it with minimum follow through 76. Really not what you want to see. 75, big bar with big risk, and 76, small follow through. It's technically a second leg down after the sell off 71, 72, 73, and you're at support, the 60 low. And that's what led to this doji right here. And then before you know it, the market reversed back up. We had a buy vacuum test at the high of the day. And just like that, it's really interesting. Just like that, the market went above the 19 high. And I made the comment that for a while, I said I thought we would go above the 19 high. And really kind of all through here, I thought we would go above the 19 high. And it took until the 3 o'clock bar for it to happen. And sometimes it does that. For stop entries, you could buy above 1, you can buy above 2, you can buy above 3, or you can buy above 9. Any of these bars, really. And then I thought it was okay to sell below 20, or if you didn't sell below 20, I think it's a little bit too late to sell down here. Selling below 20 is basically a scalp betting on a second leg. And I say scalp, it's not exactly a scalp because you're going for a profit greater than your risk. But the reality is, that somewhere down here is a buy zone. So a sell below 20 is betting on a small second leg down to test the 18 low and the buy zone. And therefore, always in bears that sell below 20, they're going to be pretty quick to get out all through here. I would definitely get out above 24. Bulls, they can buy 24, especially if they can use a wide stop. Wide stop meaning you buy more below 23, or you wait for something like 29, buy above 29, stop below 23. And then Where do traders get out? Really tough. I think it's okay for bulls to get out below 34, but it's becoming a limit order market, and therefore, when you see a big bear bar 35, it actually makes a lot of sense to buy. And then bears, bulls, if they're long, I'd get out below 40 for sure. Bears, they can sell, but then really tough, more tight trading range price action. You probably just get out, I'd get out break even. So if I saw a bar like this go up and pull back, I'd just get out break even on the trade. And then really tough all through here. You sell below 47, but if you do, you're probably going to put a stop above 19. And the reality is, if you sell below 47, we could easily go a point or two above 19 and still fail and reverse back down. So if anything, you sell below 19, you're really better. If you sell below 47, you're better off selling more at the high of the day. Selling below 19 is still selling close to the middle of the range. And then for stop entries, I thought it was really, really tough in here. Maybe you buy 64. I would not. And then I thought the most credible stop entry through here was probably selling below 71, betting on the double top, lower high major trend reversal. And instead, it just went sideways and formed a trading range. Limit orders. I thought buyers below 1, buyers below 5, and I thought buyers below 11, buyers below 16, but so late in the range, I'd rather buy a deeper pullback. I thought sellers above 21, but I don't think it triggered. I thought buyers below any of these bars down here, buyers below 28. I thought buyers below 30. I thought probably buyers below 36. And I thought sellers above 39, but it never triggered. And then probably I thought sellers above 55, that was reasonable. You can argue buyers below 63, but I'm not going to take that. And then I thought sellers anywhere up here for limit orders. And that's probably it for buy the close, sell the close. I thought probably buy the close, maybe 4 or 5, especially if you can buy a pullback. And then I thought buy the close, probably 9, 10, 11, 12, 13, any of those bars. Sell the close, 20, 22, maybe 23. I would not. And other than that, it's really buy the pullback. None of this is great. Buy the close, sell the close. So it's really not ideal. Let me take a look at questions. Okay, question, Brad. Did you decide not to mark always in long or always in short? You haven't done that in a little while. And, I'll try to do more of it. But on one hand, it's a little bit distracting. And often, on the other hand, I often just forget. And, I'm always thinking about always in, but I generally will scalp. And I'll buy scaling lower, sell scaling higher, and take small profits. And that's my general preference of trading. I like that more. But I'll try and remember to do it more often. Basically 3 legs up on the day though. Let me take a look at more questions. Why does price test a certain level? There's all sorts of reasons. One, it's testing trap traders. And an easy example, traders, you see a small bar right here on 11. That's a reversal bar on some time frame. So somebody sold below bar 11. And if they use a wide stop and scale in, they're going to make money. Another, probably the easiest example of this day is the bulls who bought 19. They buy the close of 19 and they buy more lower, like 31 or 29. If they buy here and they buy more lower, those bulls who bought here are disappointed. And it really doesn't matter whether or not they scaled in. They bought, they're disappointed. What are they going to do when the market gets back to that area? They're going to say, well, gee, I got trapped here the last time I bought. Maybe I should sell out of my longs. And that's what happened all the way up. Even right here, it tested it, and then it went lower. But then there's a lot of other reasons for test. That's the primary reason. Anyway, to explain why desperate bulls were so weak to break 19 high, but why it could not sell down. Yeah, a couple reasons. One, I don't think 19 was all that great of a buy. 19 is actually fairly low probability buy. It's consecutive buy climaxes here, here, and then here, very late in a rally, and therefore the risk is astronomically big. Like if you buy the close here, let's say you put a stop below 18, you would have needed a stop more than double the range. And so the problem, this is kind of how I think about it, is this. So here's the low of the move, here's the high of the move. This right here is basically 50% of the initial rally. And if you buy right here and you put a stop down here, what are you doing? You're going to be exiting your longs right at the midpoint, the 50%, where traders will end up buying. Traders buy 50%. Why would they buy 50%? Because 50% gives traders a one-to-one risk reward. They buy the 50% pullback, they set a target up here, they put a stop down here, and they hold, and they end up making 1 times the risk. So that's one reason. It's not that great of a buy, but it's a strong enough trend that the market should retest it. So it's kind of like over here on the euro versus the dollar. I mentioned we had consecutive buy climaxes, but I thought the April 21st rally was strong enough to get tested, even after all this selling. And look what happened. Bulls bought. They bought the pullback, and they were able to make money on the retest of the April 21st close. So that was kind of what I thought would happen. This was much stronger. It formed a type bull channel, held above the moving average, and then rallied. Here, we had so much selling. And so I thought a big problem for the bulls was all the overlap. And you can see, if we go to a Globex chart, look what's happened so far after that big bar 78. You can see on the 15-minute chart pretty easy. We had this big bull rally, and then traders immediately sold it. So price went up to a new high of the day, and what did everybody do? Everybody just immediately started selling. Why would they sell? Because they know it's in a trading range. So lots of examples of that now. It's encyclopedia. Buy the close, deep pullback, and a retest. A question, if you placed a limit order short at the top of the range, 68 to 70. So, okay, yeah, so basically I think the question is, I said I was short up here, so where would my stop be? I had an arbitrary stop at around 65.55. Why did I pick that? Because my thought was, if price goes all the way up here, then I'm definitely wrong. That's a breakout of a trading range, and if it's a breakout of a trading range, I don't want to be long. I'm okay with being long if the market goes a couple of points above the 19 high. I'm okay with that. But if we go 4 or 5 points above, I'm definitely not okay with that. And that was my logic. That's one of the hard things about, using wide stops in a trading range and betting on failed breakouts is this stop is very arbitrary. It's not that clear. And it's really easy to misjudge the stop. It seems easy. Oh, I'll just use a wide stop and scale in. Well, what do? There's plenty of examples where that actually doesn't work well. I'll find one that I'm looking for here. So here's an example. And you just say, okay, I'm going to sell right up here. I'm going to use a wide stop. But you can see what happened. Obviously, we had a trading range here, and we broke to the upside. And so for me, my default is generally consecutive strong bull bars closing above the highs. And in this case, my other default was just putting a stop up here. Plus, if I sold here, my stop is up here. If the market sold off somewhere down here, I would make whatever my risk was, my initial risk on the trade. But in this case, I got out basically a little bit better and break. I got out somewhere down here, so a little bit better and break even. Okay, last question about yesterday. A question, Brad. It's kind of a long one. Okay. I'm just going to read the questions. It's fairly limited this. Okay, question, Brad. I had a lot of confusion with the trade expectation of yesterday's bar 61 to 64. So I had a lot of confusion with these bars yesterday. Expecting a second leg up, I was expecting a second leg up, and instead it followed bar 65 to 67. So instead we got the reversal down, which looks like it deserved a second leg too. When a situation like this occurs, what should we do? And who should we expect to get priority for second legs? Similar today, should 20 to 23 4-bar microchannel get a symmetrical second leg too? So today, should 20 to 23? Okay, yeah, I see the question. Let me just summarize it in my own words. I bought the close. This is basically what the person's saying. I bought 63 expecting a second leg up yesterday, and instead we got the reversal down 66. And then here, I sold the close of 30.23 expecting a second leg down, and instead we didn't get it. Can you explain why? Basically, the issue is you're buying in a buy zone. So it makes sense. 61 outside up makes sense for the market to go higher. But the problem is that this sell-off was so tight that the higher up you go, the more in the sell zone you get. Plus, look at all the overlap. This is actually not that great of a rally. You have a really big bar, deep pullback to 62 low, rally, deep pullback 63 low, and then a small bar 64. That's basically a parabolic wedge on a smaller time frame. And then you see the surprise. Big bear bar closing on its low. That increases the risk that we could sell off all the way back down to the bottom of the range. Over here, we have a very tight bull channel, and then we have this trend line break. I said it made a lot of sense. I answered this question a little bit in the review. I said it made sense to sell below 20 because the odds are we're probably going to fall below the 18 low, and we may end up selling off somewhere down here. But I made the comment that it doesn't make a lot of sense to be selling much further than that. So as far as selling here, probably okay, but selling all the way down here, really not ideal. And therefore, and the reason for that is the odds are there's probably going to be more traders buying down here. You're in a buy zone. Here, you're in a sell zone, moving average. So I hope that makes sense. And what you always have to think about, every time I take a trade, I'm always thinking about the risk, reward, and probability. And so every time, if I think about selling here, it's easy to justify selling. I can sell below this bar. I could sell more higher. Odds are we're probably going to fall below here. But every bar that gets added, 22 and 23, that actually lowers the probability because now the risk is big. If I'm short, my stop is 22 or the high of the day. And what's the probability I'm going to make 1 times the risk? Remember, it doesn't matter if I scale in. What I'm always asking is, what's the probability we go here before here? We had an extreme example recently. Let me find it. Yeah, this bar right here. So we had a rally on the open, and then 25. We had this incredibly big bear bar. And if you just look at the bar, it's huge. It's a matter of 21 points. And one of the reasons why it failed ultimately was at some point this bar was going down. It was high probability. But then the market got all the way down here. And everyone's asking, what's the probability it's going to fall another 20 points before it pulls back? And obviously the answer is it's going to pull back. So here, same thing. What's the probability that the market is going to go another 17 points lower before it pulls back? And because of the rally being so strong, a lot of traders are not going to sell down here. So for me, one of the things traders would do is here, they're not going to sell this close of 57. Consecutive sell climaxes, and the momentum down it's climactic, and therefore the odds are it's going to pull back. So if you're a bear and you're smart, what you'll do is a bear, if you're smart, you'd actually buy down here, and you'd buy betting on mean regression to the mean. So betting on a pullback to the mean, the moving average. However, you'd buy, and then once you start to get the pullback and you see all the overlap, you know the odds favor a trading range, and you would start selling out of your longs and then start selling to go short. And then when 65 and 66 occurred, traders started selling above bars, betting on a second leg. So where do we go tomorrow? We have a decent bull bar, and right now on the daily chart, high one buy. We have on the weekly chart a rather small bar, and therefore it wouldn't take much to get back to the open of the day. The open of the day is only 30 points away, and so it really would not take much at all. So I think tomorrow is going to be a disappointment bar for the bears, for the bulls. It might be another bull bar closing on its high, but I don't think it probably will. At least I doubt it. Okay. Thanks everyone for tuning in, and I hope everyone has a great rest of their day.